Hello and welcome to another 30-minute Thursday. My name is Amit. It is 2 p.m. in the gray and rainy Pacific Northwest. We are once again live on Facebook. How's everybody doing? I hope you're staying safe. Hope you're staying healthy. Hope you're staying sane. That's always an important thing. And I hope where you guys are, the weather is better than where I happen to be right now in the beautiful Pacific Northwest. Spring has not yet officially sprung yet. It still feels like autumn. It's cold, it's rainy, it's gray. All the more reason that we celebrate the summer when it does actually arrive. But right now, what are you going to do? It's the weather. It's messy up here. That's why I'm wearing my bright orange sweater. Hopefully I can inspire the seasons to change, and it'll be a happy color with happy weather. That's what we're looking for. In the meantime, here we are live on Facebook in an otherwise gray and gloomy Seattle day. We only get like 300 of these a year, maybe 270. After that, it's all sunshine. So anyway, hope everyone's doing great. We're looking down the barrel of a recession. Let's just jump in right now. I'm going to start talking with you guys about what's going on, what to expect, why do I say what I say, and what does it mean to all of us. There's a lot going on, and I don't say this with joy, and I certainly don't want to be glib about that, because what a recession really means is it's a contraction of the economy. We either have an expansion, meaning growth, or we have a recession, contraction, meaning things come down. That's really the only two choices we've got. There's no such thing as standing still, especially in the economy. You're either going out or you're coming in. Now, that does not mean that it's going to be the same across the board. There are all sorts of different sub-markets in our economy, all sorts of different things that will be impacted differently. So as an aside, I had dinner and drinks last night with a very good friend of mine from my childhood. I mean, we go way back. Like, he knows me. His dad taught me and helped me prepare for my bar mitzvah. So that means his dad was helping me when I was 12. So we're talking about 40 years later. That's how far back I go with this guy. So anyway, he used to live here in the Pacific Northwest, and his family moved to San Antonio, Texas, and they're thriving there. They're flourishing there, and I'm happy to see that. But in our conversation, he was telling me how in downtown San Antonio right now, there's 3 new Class A office towers that are being built. And the first one is already 100% occupied with leases. The other 2 have at least 50% leased out. And they haven't even finished construction. I don't know if they've even started construction, but there's a tremendous demand for office space apparently in downtown San Antonio. Where in contrast, if you look at the Puget Sound area, you look at the Pacific Northwest, you look at Seattle proper, or some of these towers here in Bellevue, where Microsoft and Amazon and Google, they're scaling back. They're pulling back from some of their leases because in many cases, their employees have just refused to come back to campus. I will work from home or I will not work at all, is kind of what's being said out there in one way or another. And it's a big battle now between the employees and the employers. And it's weird to see who's going to win and who's going to lose in that. But right now, Microsoft especially is coming back to the Redmond campus and moving away from all of these other markets, whether it was in Bellevue or in Issaquah or in some of these other areas. They're moving back to the main campus because apparently they've got enough space now that a vast majority of their employees don't want to come into the office on a regular basis. On a more personal note, I don't know if it's personal, but it's certainly local to me, where I live. For those of you who don't know, I'm in North Renton, right on Lake Washington, and I look across the lake or down the lake to the south. There is a beautiful office project called Southport. This thing came out of the ground right around 2019, 2020. and they had a commitment at that time. This is almost 700,000 square feet in 3 towers of prime A+, big big campus for a tech concern. They were going to lease all of that out in February or March of 2020. And of course, you know what happened right around that time. Everything went stay at home, work from home, we're shutting down. And this project, as beautiful as it is, never recovered from that. And so now it has gone back to the bank, and it is going to be sold. I believe the announcement I read was in early June, they're going to have a foreclosure sale. And that's rough. That's really, really rough. It's beautiful. I don't know what they're going to do with it. Frankly, I don't know what can be done with office space that is not being utilized, right? Large plate office space, meaning like big open empty floors. Do you convert that into residential? Can you convert that into residential? How expensive is that to get individual plumbing into all these places, right? And to create interior walls and to create, like, the whole thing changes. And so honestly, I don't know what's going to happen with that. And that's a concern. But in San Antonio, they're building, and up here, they're vacating and they're going to foreclosure. In San Francisco, 29% occupancy rate in their downtown offices. It's a weird sort of thing. And so what I am sharing this with, or why I'm sharing this with you guys, is because when we say recession, it doesn't mean that the entire world comes crashing down. There are going to be some parts that are really good, and some parts that are really bad, and some parts that are in between. And it's going to be shifting and moving. The good news, and there's always good news, there's always a silver lining. Every cloud has a silver lining. As the old song goes, every rose has a thorn. The recession is going to be really good for mortgage interest rates. Really, really good. Now, how good is really good? I don't know. It'll probably start with a 5. It may even start with a 4 on the 30-year fixed. When? I don't know, 8 months from now, 18 months from now, somewhere sooner, somewhere a little bit later. These things take a little bit longer to unravel, and the effects of them take longer to materialize and manifest. But I've said time and again, and I'll share it with you one more time, that recession is good for mortgage interest rates, because when there's a recession, the economy is contracting. And when the economy contracts, inflation comes down. And when inflation comes down, mortgage interest rates come down as well. So that is going to be great. And for all of you folks who bought a home in 2022 or are buying a home in 2023, I promise you, you're going to hear from me. We're going to refinance. We're going to look to do as many opportunities to refinance as possible. What does that mean? Well, if interest rates come down by 1%, there's a refinance opportunity there. If they come down by another 0.75% a year later, that could very well be another opportunity to refinance. So we're just going to continue to monitor what that looks like and continue to keep our eyes open on the big picture of what's going on, and see what opportunities we can take advantage of when those opportunities show up. So there will be some things. Now, how do I know that there's going to be a recession? All right, let me try to get technical with you guys here. And I'm going to do a share screen. Here we go. And let's see if I can make this happen for you guys. Oh, wow. I'm so excited. I'm learning technology, guys. I can be taught, and that makes me very, very happy. Okay, so here is a chart. Okay, this is, let me try to make it big so you guys can see it. I hope that's clear enough. Okay, leading economic indicators as of March of 2023. So this is a month ago. All the statistics that we get are at least a month old. So keep that in mind. Nothing happens in real time. The statistics, it takes a little while to compile these things, and it takes a little while to do the research necessary. But the leading economic indicators, there's like 10 or 12 different data points that are known as leading economic indicators, meaning that they forecast, they give an idea of what is coming next. So these are the things that economists look at and say, well, based on this sort of calculation, shipping is one of those leading economic indicators. How many boats are coming across the Pacific with all these containers from China, as an example. Or another example, what are the costs to ship those containers once they hit US soil? What's it take to get trucks loaded up with these things and moving across the country through our network of interstate highways? Or the company that builds Kenworth and Peterbilt trucks, that's PACCAR. They're located here. In fact, it's one of the local companies that's an amazing company, but their orders for new 18-wheeler rigs, as an example, is a leading indicator, because if you need to ship more stuff, then you need to buy more rigs, right? And if you need to ship fewer things, then maybe you can make do with the rigs you currently have, right? So this is how the economy kind of works itself, or how they look at these things through economists and figure out, like, are we growing or are we shrinking? Well, the leading economic indicators are not good. And I'm sorry to say that. I don't want to mince words with you guys. I don't want to be doom and gloom either, but the leading economic indicators are down for the 12th month in a row. So for an entire year, since March of 2022, all of these indicators are saying that the economy is slowing down, that the economy is contracting, and that is leading or suggesting that we're going into a recession. We are down month over month. So from February to March of 2023. So from the month, 2 months ago to last month, we are down 1.2% on this calculation, which is twice as bad as what the economists were estimating. And so if you look at this, the dark gray graphs here are indications of recession. The dark blue here on these graphs, this is the year-over-year change in leading economic indicators, that's LEI. And the other graph is the real gross domestic product. Now, a recession, we're going to get into trouble here, and I'm sorry, I'm not trying to get into trouble. I'm not trying to be a troublemaker, but it used to be very easy to define a recession. Back in the day, we had 2 quarters back-to-back of negative growth in the gross domestic product, and that was technically considered a recession. Over the last year, there's been all sorts of different use of language, all sorts of different definitions. I'm not going to get into the right of it or the wrong of it. I'm just going to say that that is no longer what everyone talks about as an indication of recession. What is an indication of recession? I don't know. They've chosen not to define it. All right, that's a whole nother thing. But what I will tell you is simply this: when the gross domestic product comes down, it means that things are going slower than when the gross domestic product goes up. Okay, simple people, simple definitions. I'm a simple person. So right now, if you look at this here in 2008, 2009, that's this big recession right here. Check it out. The leading economic indicators took a nosedive and the gross domestic product followed suit. And as they did that, our economy entered into a recessionary period. Same thing happened here. Now, this was 08 and 09. Okay, that was kind of an anomaly, because that recession was driven in large part by the housing market and the mortgage lending space. We wrote a lot of bad loans, and they just kind of imploded and brought the entire economy down with them. This previous one over here, this was 2000, 2001. This is a recession that was caused or facilitated or encouraged, or however you want to call it, by Alan Greenspan, the Federal Reserve Board chairman at that time, because inflation had doubled. And so Greenspan decided, hey, I'm going to double the federal funds rate, basically the Fed's interest rate, to fight inflation. And he did. He fought inflation hard, and inflation came down significantly. But guess what? All those leading economic indicators, they went negative. The gross domestic product went negative, and we entered into a recession. This is historical, guys. This is, history does repeat itself. These are cycles for a reason. And by the way, this time right here, In 2001, that's when I got into the mortgage industry. Interest rates were on their way down, and there was a refinance boom in process. Now, we were also in a recession. What did that mean? What was the trade-off? For those of you who are old enough to remember, the dot-com bubble, the original dot-com bubble, burst at that point. It was supposed to burst, right? These companies were valued on a lot of hype and a lot of speculation and a lot of things that didn't make economic and financial sense. So in many ways, it was going to burst anyway, but Greenspan making money more expensive by raising the Fed rates at that time helped facilitate that dot-com bubble burst. I remember that very, very, very well. What else happened? The S&P 500, which is the broad index of stocks, fell by 50%. Not in one day, but over time, it dropped by about 50%. It has come back. It's come roaring back, but it's been 20 years. So this is part of the give and take, part of the unintended consequences of what the Fed does, part of the cyclicality of the way our economy runs, part of the consequences, right? The unintended consequences is that things will be impacted. So what can we expect in a recession? Layoffs. Employment is going to come down. Wages will come down. Stock values will probably come down. All of these things are tied together. The Fed has all but said that they want to see more unemployment. Why? Because when there's unemployment, people will take jobs at lower salaries. They don't get sign-on bonuses. They don't get raises. They don't get retention raises. The employers are out there saying, hey, look, I got a lot of people who want this job. We can replace the employees who don't want to work hard, who want more money, who want whatever. I'm not saying it's right. I'm not saying it's wrong. I'm just saying it is. And so when there's wage pressure, let me restate it. When wages come down, the amount of money that people have to spend on stuff like vacations, on stuff like new appliances, on stuff like new TVs, on stuff like new houses, all that comes down as well. So it brings inflation down. Now, does that mean that housing prices are going to come down? No, it does not. Why? I will tell you in a moment. But before I do, let me show you this one other slide here about really how bad we are expecting, or not how bad, but how much we're expecting a recession to come. This red line is a recession signal. Again, historically speaking, when the leading economic indicators come down below this line right here, it means that there's a recession that's about to happen, that's going to start. Why this red line? I don't know. Honestly, I don't know what -4 on this value means, other than to say once we hit a tipping point of a negative value that is at -4 or greater, it's inevitable that we're going to hit a recession. Well, in March of 2023, so just last month, we crossed this line on the way down. So that suggests that a recession is imminent. Now, let me move this around a little bit. I apologize, guys. I'm still trying to get the best light. Good news. I bought a ring light. Slight aside. I bought a ring light. Haven't set it up yet because it just arrived from Amazon this afternoon. So in the future, you will see this beautiful face in much brighter relief. I don't know if that's a good thing or a bad thing, but it's a thing. So I will set that up and I will do better with my video lighting and things of that nature. Okay, going back to the housing market. All right, so the question, and I know a lot of you folks are salivating, going, I can't wait for this recession to come because I'm going to scoop up a lot of houses like I was hoping to do after seeing what 2008 brought. And so bring on the recession so that I can buy houses for cheap. Okay, totally different picture. Now, I'm not saying that there's not going to be a recession. I'm not saying that as a result of a recession that people are going to lose their jobs and that people are going to lose value in the stock market and that it's going to be an unsettling and a very uncomfortable time. All of that is probably likely to happen. And I'm not looking forward to that. Okay. I don't want to see people lose their jobs. I don't want to see people impacted negatively. I can't control any of it, but I certainly feel what everybody else feels. These are not good things in general. They're unavoidable though, because our economy is cyclical, and there's there's expansion and there's contraction, much like there is winter before spring. You cannot have a spring without a winter. So take that philosophically with a grain of salt. But why do I say that housing is going to go up, even though a recession is going to bring salaries and stock values and other things down? The reason is inventory. The inventory that we have right now is absolutely bleak. Okay, this again, information from March of 2023. So just last month, there was on the ground nationwide about 980,000 homes for sale. Now that number in and of itself is skewed, because in this 980,000 calculation, about 30 or 40% of the homes that they said made up that $980,000 number, they were already under contract to purchase. They hadn't closed on the purchase yet. So the statistics are a little bit flawed. They're not available for sale because they've already been spoken for, that they just haven't consummated the sale yet. So that 980,000 is actually probably closer to like 600 or 650,000 when you take real available inventory, as opposed to inventory that just hasn't been marked fully sold yet. 650,000 homes nationwide. That is tiny, teeny tiny. In 2007, I was there. I was doing mortgages in 2007. We had 4 million homes on the ground for sale, 4 million, and not nearly the same sort of demographic strength of the buyers to purchase them. How do I know this? Because I was one of them. I bought my first home in late 2003. I am a Gen Xer. Gen X is a tiny, tiny population size compared to the millennials. Right now, the people who are 30 years old, the people who are 27 years old, those are millennials. There are gazillions of them. And it's right around that time, late 20s to early 30s, that people start buying homes. So when you think about the people who are in that stage of their life that are saying, hey, it's time for me to buy a home, there's tens of millions of them. They are the millennials. When you think about how much inventory there is less than 900,000. Like I said, there's 650,000 available homes, tens of millions of potential buyers, hundreds of thousands of available homes. Y'all don't have to be a rocket scientist to know that that is a wild imbalance. And so there's not going to be the same sort of pricing pressure that we anticipate because of the other negative consequences of a recession. The fact of the matter is that prices on homes will continue to stay, in my opinion, they will continue to stay strong. Does that mean that we're going to see 20% appreciation from one year to the next like we did in 2021? Probably not. That was a very strange year. Does it mean that we're going to see homes abandoned like we saw in 2008 and 2009 and people just walking away and letting the bank take it over? Definitely not. I will bet any amount of money y'all want that that's not going to happen. Why? Because people have equity. Even if they run into trouble, let's say worst case scenario happens for some of these folks and they lose their job. And not only do they lose their job, but they can't find another job. And not only can they not find another job, but they run out of savings. And not only have they run out of savings, they can't get a family member to help them out or a friend to help them out. And so they start missing housing payments, and they go into, late payments and things like that. So worst case scenario, and I hope it doesn't happen to anybody, but let's say that it did. The people that are in those houses have what we call equity. They have money tied into that house. They have value. The house is worth more than what they bought it for. So they have access to money. The way they access that is by selling the house. Now, that might create a little bit more inventory. Okay, that's an upside surprise. So it's hard that they are going through hardship, but that'll create a little bit more inventory. But when they sell that house, they're going to pay off their mortgage. They're going to get a profit. They're going to take that money and they're going to do something else with it. Maybe they become renters for a little while until they get back on their feet. Maybe they move their family to a different state where the economy is different because they've got different policies. They've got different politics. Like I said earlier, San Antonio is looking for office towers, because they've got people that need to be put in offices. Whereas Seattle, San Francisco, here down the street from me, we see vacancies in offices, right? So it's not the same thing across the board, but that person who sold that house and took their profits could potentially move to a different state or a different city where the economy is different and they could find different work. They could find different opportunities. So that is likely to happen. That's going to be an outcome. How profound of an outcome? I don't know. We'll find out after the fact. Years later, when the smoke clears, we'll have another 30-minute Thursday, and I'll say, hey, remember that wacky 2023, 2024? And then we'll look at those numbers. But for those of you who are thinking, wow, housing prices are going to come tumbling down because of a recession, it's not going to happen, because I don't have to sell my house at a loss. And a lot of the people that could face this pressure are similarly situated. They don't have to sell their homes at a loss. So why would they? I'm looking at the time here. Okay, we've got a couple more minutes. Cool. So let's talk a little bit more about this slide and these statistics. Now, remember, this is nationwide, guys. This is nationwide. So take it with a grain of salt. In the Seattle market, things are even tighter than nationwide because we've got such limited inventory and we have really very little new construction going on. For those of you on Facebook, you saw I posted a photo from across the street from my home. That's how we have new inventory. Someone buys a tear down house, tears it down, builds a new house. That's it. That's where we get a lot of our inventory. Okay, but more of this information here. Nationwide, they claim that there's a 2.6 month supply of inventory. A normal market is 4.6 months. What does that mean? Basically, if there's no new listings and no new construction, whatever's on the market right now will be sold and gone within 2.6 months, and there's nothing left. So a very low supply of inventory. Days on market, 29 days, down from 34 days. Again, in the Seattle area, significantly faster turn times. So take that with a grain of salt as well. 65% of the homes sold in less than 30 days. It was 57%, now it's 65%. So it's moving up. I mean, there's really, it's heating up. Okay. First time home buyers, 28% made up the market. Cash buyers, 27%. So we're not even tabulating those folks. I don't know how to tabulate that, because if you're not applying for a mortgage, I can't even calculate how many people are doing that. Let me show you one other slide here since I have it. And it's really interesting. Redfin did a housing report. I'm not going to speak ill of Redfin or well of Redfin. I'll let you guys formulate your own opinions on them. But this headline is very misleading. Home prices fell 3% in March, the biggest annual drop in over a decade. When I worked for a newspaper, we always said the same thing. If it bleeds, it leads, meaning that if it's bad news, we want to get it up front, above the fold on the newspaper. We want to make that big headline. We want to scare people to buying the paper so that they would read our stories. If it bleeds, it leads, meaning bad news definitely comes first. Good news is on the last page, right? This is very misleading because they're talking about the median home price. The median home price is basically if you draw a horizontal line and this side is 0 and this side is 100, median is 50. Half of the homes are more expensive, half of the homes are less expensive. That's all it means. It does not mean the average price. It does not mean the average appreciation. It just means that median prices are the middle price. In reality, the median price in March of 2023 went up by 3.6%. It just has gone down a little bit from last year median price. Whoop, my computer almost fell off my stack here. That does not mean that home values are coming down. That does not mean that we're going to see a sell-off. In fact, if you look at this, 44% of the homes sold had multiple offers. Now, y'all in the Seattle area, You know what that multiple offer is. No one's offering below asking price on a multiple offer situation. Prices are only going up. Values are only going up. Inventory is coming way down. Once again, new listings year over year fell by 23.3% year over year, the lowest level of listings on record. Zero supply, a bunch of demand. There's no way that prices are not going to go up, even though there's other economic pressures like a recession looming. That's just the weird thing, right? Good times, bad times, best of times, worst of times. San Antonio market has demand for office building. The Seattle market, San Francisco market, not so much demand for office buildings. It's some weird stuff going on. Bottom line, because I'm at my time. I can't believe it's already 30 minutes. Bottom line is, if you want to build wealth, if you want to create a pathway toward your retirement, if you want to create a pathway toward enriching your family, if you want to create a pathway toward other things, owning real estate, residential real estate is a great way to start. It's a great way to build wealth. That's what I'm all about. I want to help you guys do that. Good economies, bad economies, whatever it is, we still need a place to live. So please make use of your phone. Call me, DM me, Facebook Messenger me, text message me, send me a courier pigeon, reach me, talk to me. Let's make a strategy to help you navigate this very strange time and to help you find a way to take advantage of the opportunities as they come up so that we can buy real estate together and help you reach your goals. I look forward to hearing from you guys. I want you guys to call me. Please don't be shy. Don't be strangers. Make use of that phone. Until then, I will see you next week on Thursday. I can't believe it. It's going to be the last Thursday in April. Holy moly. It's a third of the year is going to already be gone, but I'm already over time. So I will wish you guys a wonderful day, a fantastic weekend. Stay safe, stay healthy, stay sane, stay in touch, and I will see you next time. Y'all take care. Bye-bye.